The big news for the week in the real estate market is that mortgage rates plunged Friday to roughly 6% to close the day at the lowest level since 2022. For anyone shopping for homes this spring, that's welcome news. So now we get to watch the data to see if anyone cares. My guidance is that rate changes typically push demand faster than supply. So that means we should see the demand indicators move first. We'll look at those today. If demand picks up, do we see it at transaction volume? Do we see it show up in prices? In the past 4 years, when rates have dipped, we've seen prices display surprising resilience. Prices jumped in the spring of 23 and again 18 months later in the fall of 24. Now, I'm not sure that home prices will respond as quickly this time because there are more homes for sale in most of the country. We'll look at the latest price data today too. In our 2026 housing market forecast and outlook report, I wrote about the Goldilocks scenario that helps sales really grow this year. One of the factors that would have to click in order for the Goldilocks scenario to emerge is a drop in mortgage rates in Q1. Well, it looks like we may have factor one clicked into place. A big jump in home sales probably requires other factors like an improving jobs market, but lower rates is a welcome first step. So it'll take a few weeks of lower rates before you can really see the needle move in the data. So today we'll focus on what we already know and what we'll be watching for as the spring housing market for 2026 emerges. So let's start today with this view of mortgage rates over the past 4 years. With the dip on Friday, rates are now at their lowest level since the summer of 2022. Since then, there have been 2 other times when rates got close to 6%. In both of those periods, demand picked up. Sales increased and prices did too. Those 2 moments were early 23 and again in September 24. I've highlighted those 3 periods with the new one too in this chart. So this is fortuitous timing for the spring housing market. A typical mortgage payment for the median price home is now 10% cheaper than it was last year at this time. Last year, rates were 100 basis points higher. Mortgage rates are lower because the spread has compressed. The Trump administration is using Fannie Mae and Freddie Mac cash to buy mortgage-backed securities with the explicit goal of decreasing mortgage rates. And it worked on Friday. The underlying 10-year Treasury yield has not declined and is still trading about 4.2%. So could mortgage rates go lower? If weak jobs data lets the 10-year yield ease and the GSE balance sheets have room to load up on more MBS, then yes, rates could continue to ease down into the fives. What I'm more interested at the moment is in measuring how consumers respond to these newly lower rates. And that's why I want to start today with this view of price reductions. The percentage of homes on the market with price cuts may be the most sensitive indicator to demand shifts, often within just 1 or 2 weeks. So this is the fastest demand indicator. Right now, just under 35% of the homes on the market have taken a price cut from the original list price. In the spring, starting now, each week has fresh new inventory, and those listings haven't taken price cuts yet. So this line curves down for a few months. Sometime in February or March, those early listings grow a bit stale, so price cuts start climbing again. So you can see the normal seasonal curve here in this chart with data over the last decade. Each line here is a year. So here's what we're watching for. Some years, like 2023, that's the yellow line here. They start off with a slow market, but we can see demand accelerate. So see how that yellow line heads lower for longer than the other recent years. So that's a very clear indication of demand picking up at that time. So in early 23, demand picked up because rates dipped back down to 6%. There was a lot of cash in the system from the pandemic still. So this data at that time surprised me in February of 23 because it showed there were more buyers than I had expected. after a very slow end of 22. So this yellow line showed this demand months before it showed up in other headlines. So contrast that to 2025. Last year, mortgage rates started the year over 7% and stayed high all the way through June. You could see the negative impact on buyers in last year's purple line. So when rates were high, buyers stayed away, price cuts started early and escalated all year. So now we have this sudden drop in rates, the lowest level in several years. So the question is, how much demand does that shake free? To answer, we're going to watch these price cuts over the next several weeks. So right now, just under 35% of the homes on the market have had a price cut. That's a little more than when we started last year. The downslope looks encouraging, though, as a very early signal of this demand that we're looking for. In the next few weeks, if demand is responding to lower mortgage rates, you'll see the blue line, 2026, dip below the purple line. If homebuyers are not convinced by good news, then the blue line will stay above the purple. So stay tuned for that. I think it'll be very clear. All right, now let's look at the supply side of the equation. There were 39,000 new listings for single-family homes this week across the country. That's actually 10% fewer than the same week a year ago. The early weeks of the year still have some holiday influence, so I wouldn't read too much into the fewer sellers this week. But there is something very important to watch in the weekly new listings data this spring. Last year, we had a lot of withdrawals. Do those withdrawals return as a flood of sellers who try again in 2026? There are a lot of folks who look at the housing market and see this only as latent supply. So sellers who tried and failed and will try to sell again. So my suspicion is that we will see demand first. So we'd see that price cuts line decline faster, but no real pickup in the new listings, the supply side, until later in the year. So if demand picks up faster than supply, which I expect is normal, then we will not see any spike in the new listings this spring. If sales are going to pick up substantially, though, we will need to see more new listings, for example, in the Midwest and Northeast. We need to see more sellers in Chicago and Boston and New York. As of now, for the second week of January, the new listings are lower than last year. So watch this data point each week to see if that continues, especially if you're expecting a flood of sellers this year. So if that happens, you will see it here first. If it hasn't happened yet, but we will report it, of course, as soon as we see it. So fewer sellers, high withdrawals means inventory shrank by 33,000 homes this week. That's a bigger holiday drop than any recent year. It's more in line with how the market used to behave in the last decade. There are 686,000 single-family homes on the market unsold right now. The result is that the inventory of unsold homes is now 10%, only 10% greater than last year at this time. So this growth rate was over 30% a few months ago. Last year, demand was weak with high mortgage rates, and inventory was climbing quickly. Inventory growth is way down in places that might surprise you. Florida, as of this week, has only 1.4% more homes on the market than a year ago. By next week, Florida may have fewer homes on the market for sale than in 2025, by next week. That fact will surprise a lot of people. California is just barely positive. Texas has 10% more inventory than last year. The takeaway for inventory in the spring of 2026 is that supply in the biggest markets is not growing nearly as quickly as it was. So we've shifted into this new era of the market. There were 40,000 single-family homes sales started this week, with another 8,000 condo sales newly pending. So that's averaging just a tiny bit ahead of last year, 1.4% weekly more pending sales. In this chart, the blue line at the left end of the chart is just barely above the sales levels of 2025. The purple line, in the next few weeks, I'm going to be very curious about what happens to these sales offer levels. So we've talked about newly cheaper mortgage rates, of course, which is the headline right now. But home buyers also have to think about other factors like job security, and the hiring rate in the economy remains very low. 2025 was a very weak economy for jobs. As we roll into 26 with the administration suddenly prioritizing the housing market, how do consumers respond? Are they more worried about their jobs than the payment levels? We've had tiny bits of sales growth over the last few months, a couple percent gains. So I'm watching the weekly pending sales as a more concrete measure of demand. So this will take longer to move the needle than the price cuts number. So I would grow optimistic if we see the weekly pending sales number start to average about 5% more than 2025. It's not there yet, still early January, but it is possible. Because remember that last year sales were really hammered by mortgage rates on the way up over 7%. So the annual comps should be easier this spring to show sales growth. If homebuyer demand picks up with newly lower mortgage rates, what happens to prices? We've already seen that supply is not surging. So if increased demand is met with tighter supply, how quickly do prices react? If demand responds enough, do home prices have a bounce? I haven't seen any data yet that leads me to forecast that home prices are climbing notably in 2026. Here's where we're starting the year. Home prices, by any of the measures, ticked up this week. The median price of the newly pending contracts is around $382,000. You'd expect an uptick for the spring. We're past the holiday seasonal low for prices, and each week now until like June, prices move higher. The best homes meet the most demand, so prices seasonally climb through June. At $382,000, the price of the weekly pending sales is about 1.4% higher than last year. The asking price per square foot, which I'm showing here, is 1.2% below last year. So that's actually improving. It was closer to a 2% decline recently. So, but we're really in this plus 2% or minus 2% band. Home prices are basically unchanged from last year. So we've described 2026 as an opportunity for affordability to improve because home prices are flat while incomes grow. And that remains my outlook for the year, even as we're watching closely for how potential home buyers react with the new low in mortgage rates. The price number here will be slower to react than some of the other measures. As of now, home prices are basically unchanged from last year, depending on which measure of home prices you use. So mortgage rates are at their lowest levels since 2022. Home buyers this spring, that's good news. Over the next few weeks, we'll measure how many of those potential home buyers take advantage. So stay tuned.